All right, so on to step two. So as mentioned before, step two is to only invest when the stock price is undervalued or is fairly valued, and ideally at a support level or during a dip on an uptrend. So again, if you take a look at Procter& Gamble, you can see that over time, if you were to invest in this business, you will do well because the business increases in value. But over that period, the share price would fluctuate because of volatility, because of news in the market between being overvalued and undervalued. And we only want to buy, as I've mentioned before, we only want to buy when the price is below the valuation or near the valuation. So again, anything below this green line is undervalued. Anything above the green line is overvalued. So we want to avoid buying when the price is above the intrinsic value, ideally, and we want to buy when the price is undervalued during these points of time. Okay, but at the same time, we also want to buy when we see that the price is beginning to have some bullish price action. In other words, the price is beginning to make higher highs and higher lows, and not buy while it's still on a downtrend. One of the most famous quotes that was said by Warren Buffett years ago is that be greedy when others are fearful, and be fearful when others are greedy. So you have to take a contrarian view to the short-term market if you want to profit in the long run. So when are people fearful? People are fearful during crisis, bad news, recessions. And when they're fearful, share prices tend to temporarily go lower. So start to be greedy and buy when people are fearful. And when people are greedy, that's when everyone starts to buy stocks. And when people are greedy, that's when prices tend to get a bit too far ahead of itself. It begins to be overvalued and be fearful during those times. So this is step two. So question is, if a business is a great business, if it's making a lot of money, will there be times when its price is undervalued, when its price is selling below its true value, when we can get a really good discount of the valuation? The answer is yes. So when does this happen? This happens during these circumstances. Number one, when investors have a negative perception of the company. So sometimes there's nothing wrong with the business, but people just have a negative perception of the business for some reason because of generalizations. And I'll give you a few examples. So during the financial crisis in 2008, 2009, what happened? Lehman Brothers went bankrupt. AIG almost went bankrupt. Citigroup almost went bankrupt because a lot of these banks and financial institutions were holding what we call these collateralized debt obligations, CDOs, that became worthless when the property market collapsed. So as a result, the share prices plunged. So at the time, people were fearful of any business in the financial sector. They said, you know what, if one bank is bad, they're all bad. They're all gonna fall. So what happened is people started selling all their shares in all the financial companies. Now, question is, were all the banks bad? No. There were some banks like Wells Fargo that had very little exposure to the financial crisis, but their share price also fell by 50%. Why? Because people had a perception that they were a bank, they'll be in trouble. But they weren't in trouble, they were doing well. Okay? American Express had nothing to do with the financial crisis, as in that they did not hold any of these toxic mortgages on their balance sheets. But again, people did not dare to hold anything with a financial exposure, and people sold like crazy, and stocks like American Express dropped by 60% because of people's perception. And again, those were times when it was a great time to buy American Express. It was a great time to buy Wells Fargo, selling at a huge discount. And I'll show you some of the charts later to further illustrate. Another example would be a couple of years ago, there was a food scandal in China. All right. Oh, I'll talk about that one in a short while. Let me talk about oil and gas. In 2010, there was oil well explosion by BP, which is one of the petroleum companies. And when the oil well exploded, there are people who died, unfortunately, and the environment got badly polluted. And BP was sued by many governments and companies, right? And the share price dropped by 50%, which was understandable because people were afraid that BP would go bankrupt. BP will lose a lot of money. But here's the interesting thing. When BP went down, other related oil companies like ExxonMobil, like Shell, went down as well. Why? What did they have to do with BP? Nothing. It was just that they were in a related industry. So people tend to have a perception that if one company is bad, they're all going to be bad. And they sell off all the companies in the same sector. So those are great opportunities to buy good companies selling at a discount purely because of bad perception. And again, I'll show you some of the chart examples in a short while. So that's number one. Number two is a company makes a stupid mistake that hits its short-term profits, but in the long run, its business model, its economic mode remains intact. And no matter how good a business is, it makes stupid mistakes, or it's affected by something that was just a short-term problem. And again, a good example would be a couple of years ago, there was a food scandal in China where Yum Brands that owns KFC and McDonald's, they bought expired meat from a supplier. So when people went to the restaurants, they had food poisoning, some people died. And people were afraid of eating at McDonald's and KFC. So as a result, what happened in the short term, they lost money and the share price dropped by 20-30%. And it was that time I saw it was a great opportunity to buy up shares of Yum Brands and McDonald's. Why? Because question, is it a short-term problem? Yes. Would they eventually sort it out? Yes. Okay. So sure enough, eventually when the crisis was over, the share prices went back to where it was, and it gave me an opportunity to buy when it was undervalued. Sometimes stuff happens that the company can't control as well. Like many years ago, there was a mad cow disease. And what happened was people who ate beef died because of the disease, and people did not dare to eat at McDonald's. And again, the share price fell by 30%. And I said, that's a great opportunity to invest. So I bought McDonald's. Why? Because the question is, will the cow be mad forever? No, one day the cow will be happy again, right? So sure enough, temporary problem gives us a buying opportunity, okay? Another recent example is one of Facebook. So as you know, Facebook was fired or, was attacked by people who accused it of selling data that actually helped the Russians to interfere in the 2016 US elections. So because of that, people started deleting their Facebook accounts, some people in protest, and Facebook's share price dropped by 20-30%. And I said that's a great opportunity to buy Facebook, because again, in the long run, they will sort out the problem. It's just a temporary problem, okay? But we do not want to buy companies that are hit by problems that could be permanent, that could do permanent damage to its reputation or to its business model. So sometimes it's not exactly clear, but that's where further research will give you a clearer picture. Next, a bear market. So what's a bear market? A bear market is when the entire index, the whole market is on a downtrend. And again, like I mentioned, that happens once every 8 to 10 years, triggered by an economic or financial crisis. Now, here's something interesting. When the entire market is going down, 8 out of 10 companies will go down together with it, even though the companies may be doing well. Why? Purely because of perception. When people are fearful, they sell everything. And good companies, as well as bad companies, will collapse during those times. So during a bear market, it's a great time to buy companies at 50% discount. But again, don't buy when it's going down, right? Wait for the downtrend to find a bottom, to consolidate, or to reverse into an uptrend. Again, more on that in the later lessons. Next, industry recession. So every industry will go through a recession at times. And what happened about 2 years ago, which was 2016, was oil prices collapsed from $100 per barrel to about $25 per barrel. So when oil price collapsed, which industry went into recession? Oil and gas. So ExxonMobil, Shell, Chevron, ConocoPhillips, their share price started collapsing. And again, those were opportunities to buy the leading companies at a huge discount. Because we know that these leading companies will survive, they will make it. And eventually, in fact, many of their competitors would die because of the industry recession, making the leaders even stronger. All right. During the financial crisis, the real estate market was in recession. So there was a great time to buy home building companies or property developers when they were selling at huge discounts. But you only buy the market leaders because you have to be sure that they will not go bankrupt, that they will eventually survive and go on to greater heights. Okay. Next will be wars and disasters. Now, no one likes wars, no one likes disasters, but they can give us great investment opportunities for the short term. So whenever there's some kind of threat of a war, for example, when Donald Trump started to have this verbal sparring match with Kim Jong-un of North Korea, and there was a fear of this Korean crisis, the stock market just went down really fast and then bounced back eventually when they did not eventually go to war. We had the Fukushima nuclear disaster in Japan because of the earthquake, right? We had the Afghan war. We had the 9/11 war on terror. So every time there's a crisis, a war, the stock market tends to react. There's a knee-jerk reaction. Prices drop really fast by about 10-20%, but very quickly in 1 or 2 days it goes back up again. So when you've got great businesses on your watch list and you're waiting for these opportunities, when they sell off, start to accumulate them when they're selling at a discount, right? So that's what we do as investors. So let's take a look at some examples on the chart. So what I'm looking at here is Yum Brands. Again, Yum Brands owns KFC, Taco Bell, and Pizza Hut, and Long John Silver's, right? So you can see that the stock was going up really nicely on a very nice uptrend. And the intrinsic value, as I calculated it at that point of time, was $65. So stay tuned to the lesson on valuation, where you will learn how to value a company's intrinsic value. So I knew that it's worth $65, right? But what happened? During this time, we had the food scandal, like I mentioned earlier on. And people panicked and said, oh my God, they're losing money. People are not eating at KFC anymore. And they sold, and the share price went from $65, boom, all the way to about $40. So it was selling at at about a $20 discount. So there's about 30% discount of the intrinsic value. But again, as it's going down, you do not know how low it can go. So it's really risky to buy it on the way down. So I was waiting for a signal that the price was reversing back up. So a few things I look at. Number one, of course, are the moving averages. So when I saw that the 50 moving average was crossing above the 150 moving average, and they were sloping up, I say, hey, that's a good opportunity. So I started buying here. And when I bought at about $55, it was a great entry price because I bought it undervalued by about $10, and it went all the way to $90, and it's still going up even higher today. So these were great opportunities to get in, all right? Another example would be, again, I mentioned in 2010, the BP oil well explosion. So I was looking at a related company, ExxonMobil, which is also an oil and gas company. In fact, ExxonMobil is the market leader. And again, the share price was on an uptrend, as you can see over there, when moving averages were sloping up, the 50 above the 150, and it kind of hit a resistance over there. And the intrinsic value of $67. So you're selling at valuation. And then when the BP fiasco came, people panicked and started selling off all the oil companies. And from $67, BP went all the way to, in fact, about $42. So again, it was almost a $30 discount, right? Almost a 40% discount to its valuation, right? And you can see as it's going down, right, it's making these lower highs and lower lows, okay? So this was a time when it was a bit risky to buy. We wanted to wait for a confirmed change in trend. When again, the 50 crossed above the 150 and it's sloping up, We could buy here and then ride the trend all the way back up again. If I zoom in, you can see that this was actually a risky time to buy, although the 50 did cross above the 150, but the 150 was still sloping down, okay? And you can see the 200 moving average acted as a resistance. It couldn't break it and came down again, right? Now, you could also have bought here, in fact. You may have said, hey, the 50 moving average is above the 150, it's sloping up. You could have bought there at about $55, as you can see, $55 somewhere there. And if you had bought there, what would have happened? It would have still dropped to $45. So the point about investing is you can't always catch the bottom. You don't always know where's the bottom. We can't be 100% right. But if you know that it's a good business, if you know that eventually it will go up, you don't have to buy the bottom. You have to buy somewhere near the bottom. And again, whenever you invest, now again, investing is different from trading, right? Trading is covered in my trading cost. In investing, you never put all your money in at one time. You buy in stages. You do a bit of dollar cost averaging. So at $55, you have started buying a bit of ExxonMobil shares. And when it went even lower here, and it started to reverse back into an uptrend here, you could have, that's right, added more. So you kind of like average your cost, but you can't catch the bottom. So you buy when it's near the bottom or when it's coming back up again. And right now at $90, you have made a really good profit. There you go. So the good thing about investing compared to trading is that for investing, you don't have to time your entry exactly because you're not buying one time. As I mentioned, you're buying in stages as long as it's near the bottom and it's starting to go on a new uptrend. Okay, so last example is the subprime mortgage crisis in 2007 to 2009. And I talked about how this crisis affected all the financial companies. So this was American Express. And again, American Express is a great business. It's got a great brand monopoly. So in the long run, we know it will always go up. But during the financial crisis, people panicked and they sold everything that was related to the financial sector. And from $55 per share, American Express collapsed to $7 per share. Can you imagine? $7.50. So most people have said, oh my God, why has this happened? Again, in the short term, the stock market is irrational. It is purely emotional. And in the short term, a company worth $40 can be selling at $7. That's right. So the intrinsic value was $40. Now, if you had done a valuation, you know that it's worth $40 and $7 was a steal. It was the great Wall Street sale. But again, you would not know where the bottom was. So again, if you had bought on the way down, you would never know where the bottom is. So that's really scary, right? So always wait for the price to kind of like reverse and for the price to at least get above the 50 moving average. So at this point, when the 50 moving average crossed above the 150, you could have started buying somewhere over there. And again, you wouldn't have caught the bottom, right? It'd be really difficult, but you have bought it at least $20. And buying at $20, you're still getting a 50% discount. And you know, once the crisis was over and people's confidence came back, they started buying back again, realizing they panicked for no reason. The price went all the way to $90. Okay, within a couple of years, and now it's even higher than that, right? So that's the idea. Buy a great business at a discount, at a good time. All right, finally, step 3, when you exit an investment. Warren Buffett famously once said, as a great investor, you hold forever. Well, there are times when you want to exit an investment, especially when the business is no longer as good as it once was, once fundamentals deteriorate. And again, you're going to learn how to read the fundamentals in the next lesson. So for example, once a company starts to see a consistent decline in its sales or profit margins, or the company loses its competitive advantage, those are times to exit the investment, take the money and redeploy to a better business. Or sometimes you may exit an investment, although it's still a good business, but the price has gone up so much that it's overvalued, it's overextended, way above the moving averages, way above the intrinsic value, and you say, hey, you know what, it's now going on a downtrend. You could always do an exit, keep the cash, and attempt to buy it back at a lower price. So you could do that as well. So an example would be IBM. IBM is a company that Warren Buffett bought about 3 years ago, and at that time he said, or he thought it was a great business, it was undervalued, and after holding it for a few years, he admitted that he made a mistake. So remember that if the greatest investor in the world can admit he made a mistake, all of us can do that as well. So remember, being a great investor is not about being right all the time. No one can be right all the time, but it's about being right more than you're wrong. And what's even more important is that when you're wrong, you lose less. When you're right, you make more than when you lose. So even if you're right half the time, or slightly more than half the time, you will be profitable as long as your average winners are more than your average losers. But if you have got a mindset where I must be right all the time. I cannot be wrong, so I refuse to sell even at a loss. What's going to happen? And you hold on to a bad investment. Sometimes a small loss from a bad investment can weigh you down and create a bigger loss. Or sometimes by holding on to a lousy investment, not selling it, your money's stuck there and you can't deploy it to a better business that can make you higher returns. So always remember to think logically and not emotionally in the market. So here's an example. So IBM, as you can see, was doing pretty well at this stage. It was on an uptrend and it started to become pretty overvalued at 185. It was getting a bit overvalued, right? But as long as the trend is still up, you could hold it. But over here, you can see that the trend started reversing down. When you see that the 50 moving average started crossing below the 150 moving average and it started sloping down, right? That could have been a time to get out of the stock at 175. And again, don't always hope that you can sell it at the top. No one knows where the top is. As long as you sell it somewhere at a reasonable price at 175, and if you have bought it at say $90, selling at 175, you've made a pretty good profit. And you could have gotten out before the trend started going down and the company started to deteriorate in terms of its business fundamentals. And well, if the business continues to be good, you can always buy it back. But if it's not, find another company, find another stock to redeploy your cash. So that summarizes the 3 steps to successful investing. In the next lesson, we'll be diving deeper to learn how to identify a really good business by studying the company's fundamentals and financial statements. So I'll see you in the next lesson.